Most real estate investment trusts, or REITs in short, are today in a strong position to keep growing their dividend payments. That's because REIT payout ratios are today at a historically low level at around 75%. Then secondly, REIT balance sheets are today the strongest they've ever been. Thirdly, rents in most property sectors continue to grow, and this growth should even accelerate going into 2025 because the surge in interest rates had put most new development projects on pause. Then fourth, REITs continue to acquire more properties and buy back shares with their retained income. And then finally, interest rates are also expected to be cut sometime over the next year, and this should be another catalyst for dividend growth in the REIT sector. This explains why so many REITs have already hiked their dividend in the first half of 2024, and I expect many more hikes in the second half. Good examples are Realty Income, Vichy Properties, and Simon Property Group. But not all REITs are created equal. Some REITs were too greedy in the past years and they took on too much leverage. Others set their payout ratios at unsustainable levels. And then some are also exposed to cyclical sectors that will likely face some pain in the near term. This is why it's so important to be very selective when investing in REITs. A lot of new investors will commonly go after the REITs that offer the highest dividend yields, but they would then suffer large losses as these REITs eventually cut their dividend. Hey everyone, this is YCHARTS. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to highlight 5 REITs that I expect to cut their dividend over the next year. But before I get into it, I want to remind you that we just recently launched a new YouTube channel that will cover other high-yielding sectors such as MLPs, BCDs, closed-end funds, and so on. And we are now nearing 1,000 subscribers. I would really appreciate it if you go check it out. We just recently posted a few videos on some of our favorite investment opportunities of the moment. I'll put a link to it in the description of this video. So the first REIT that I think is quite likely to cut its dividend is called Medical Properties Trust. Its ticker symbol is MPW. I actually hold a small speculative investment in Medical Properties Trust, and I like its risk to reward for more aggressive investors. However, I see it as a deep value type investment that's very speculative, and I wouldn't buy it for its dividend because I think that it's likely unsustainable. What you need to know here is that the company is facing a perfect storm. The company has too much leverage with an estimated LTV of around 55%. It has significant debt maturities coming its way in the coming years. Because of that, it's now forced to sell some of its best assets to raise liquidity and pay debt maturities. Then fourth, its biggest tenant called Steward is going through bankruptcy, and there's still significant uncertainty and question marks on what's going to be the outcome of this bankruptcy. Most likely, Medical Properties Trust is going to have to release some of these assets to other tenants, quite possibly at significantly lower rent levels. We expect 10 to 20% cuts in most cases, and if you take all of this into account, you really have a perfect storm that's likely going to force the REIT to cut its dividend. The management's recent commentary seemed to imply that the dividend is sustainable, and in fact they just a few days ago reaffirmed it. But I would note here that this management team has consistently overpromised and underdelivered in the recent years, and therefore I wouldn't put much value to that. I would actually welcome a full suspension of the dividend, at least until the Steward bankruptcy is resolved, more properties are sold, and the near-term debt maturities are either paid off or extended. How I see MPW is that this is likely going to be a double or triple in the coming years or zero. And so I think that paying a dividend is increasing the risk of this becoming a zero simply if the company cannot make its debt payments. And so I would much rather focus them on raising liquidity levels to increase their chances of surviving and seeing the recovery. So once more, I wouldn't buy Medical Properties Trust for its dividend. Yes, the yield is high, but it's likely not sustainable. This is a highly speculative, deep value play. And final disclaimer, I've been wrong on Medical Properties Trust so far, so make sure to do your own research. Then the second REIT that I think will likely cut its dividend is called Easterly Government Properties. Its ticker symbol is DEA. This REIT is very popular among individual investors specifically because of 2 key reasons. Firstly, most of its properties are rented to government agencies, and therefore its rental income is backed by the full faith of the US government. And secondly, despite that, the company is today priced a roughly 9% dividend yield, which represents a significant spread relative to what you could get from treasuries. And since this is a real estate investment, a lot of people appear to think that on top of this 9% yield, you also get inflation protection with it. But if it sounds too good to be true, it probably is, and in this case there are significant questions about the sustainability of this dividend. Firstly, the payout ratio is very high. It's right around 100%. It's one of the highest dividend payout ratios in the entire REIT sector, and that on its own probably tells you that it's not sustainable. Secondly, the REIT has quite a lot of leverage. Some of that will need to be refinanced in the near term, and that's going to significantly increase its interest expense. Just recently, they issued some new notes at a 6.6% interest rate. And then finally, and perhaps most importantly, a lot of its properties are office buildings, single tenant office buildings that are leased to government agencies. And I think that in this specific case, having the government as your tenant is actually a disadvantage. That's because the government holds even greater bargaining power with landlords, because they know that many other landlords will gladly rent their property to the government, since it would lower the cap rate of the property and increase its value. Moreover, the physical occupancy rates of office buildings that are leased to the government is today even lower than those that are leased to regular businesses, likely because the government is not so worried about the productivity of their workers. Therefore, as increasingly many of its leases now start to expire, expect DEH suffer some vacancies. It will have to also heavily reinvest in some of its properties. It will need to grant tenant improvements, reduce rent levels in some cases, and this is likely going to force the REIT to cut its dividend. And a final point I would make here is that the REIT actually isn't that cheap relative to the rest of the REIT market. Yes, the dividend yield seems high, and that seems to imply that it's cheap now, but the 9% dividend yield is simply the result of them maintaining this very high payout ratio. But relative to the FFO, they are priced at around 11 times. The discount to NAV is only about 15 times according to the average estimate of analysts. There are a lot of high quality REITs that are a lot cheaper than this, and therefore I don't see much point in investing in DEA at the moment. Hey, before I go into the third REIT, please let me know in the comment section below if you like this type of content. Do you think it's valuable that I do videos on REITs that I dislike to highlight their risks? Or do you prefer me to just focus on REITs that I'm buying at the moment? So far I've been focusing on the good and the bad, but let me know what you prefer. And also, if you could please click the like button, that helps me a lot to grow this channel. Thanks so much in advance. Then the third REIT I expect to cut its dividend is called Global Net Lease, ticker symbol GNL. I'll keep this one short because I've highlighted it quite a few times on this channel. So far, we have correctly predicted the two previous dividend cuts of the company. We correctly predicted the one that happened, I think was in July of 2023. And now just recently in April, they cut it a second time as we had predicted. And I think it's quite likely they will cut it a third time in the near term. Maybe not this year, but perhaps next year or in 2026. I don't think that this dividend is going to be sustainable over the long run. That's simply because the REIT has a lot of leverage. It owns a lot of risky, high cap rate properties that probably going to suffer some setbacks down the line, some vacancies, and require a lot of capex. And perhaps most importantly, this is one of the REITs with the worst management team, in my opinion. If you look at their historic performance, it's really among the worst in the REIT sector. They have consistently made poor decisions, like raise a lot of equity when their cost of capital was too expensive to buy additional properties, diluting shareholders in the process, but likely then justifying higher compensation for the management because it grew the portfolio size. And yes, recently they internalized their management, which on paper looks good. It would seem to imply that this would reduce future conflicts of interest, but the same people are still working for the REIT. I personally don't trust them. This is just my personal opinion, and therefore I have no interest in owning this company, regardless of the valuation, really, because if you look at Global Net Lease, it has always seemed to be very cheap. It's always offered at a high dividend yield, a very low multiple, and despite that, it keeps underperforming and delivering horrible returns to shareholders. I don't think that this is changing anytime soon. I think another cut is likely coming in the coming years. I'm staying away. Then the fourth REIT I expect to cut its dividend is called Service Properties Trust, ticker symbol SVC. This is a bit of a similar story as Global Net Lease in that the company is mismanaged, in my opinion. It's externally managed by a company called RMR, which is notorious for being arguably the worst external manager in the REIT sector. They manage several other REITs, and all of them have horrible historic track records. They have historically always over-leveraged the REITs, bought a lot of lower quality, high cap rate properties, and then they kept on issuing equity at poor times to make ill-advised acquisitions. They've done everything wrong that you can imagine in a REIT historically. And this specific REIT today, its payout ratio is relatively low, but they have a lot of leverage. They own a lot of cyclical properties like hotels. Their interest expense is going to go up quite significantly over the coming years. And so yes, I think that another cut is quite likely. And then the fifth and final REIT of this list is going to be Apollo Commercial Real Estate Finance, ticker symbol ARI. This is a commercial mortgage REIT. It's a lender of capital to other real estate investors. And it made the mistake, just like other lenders, of lending too much money when cap rates were really low leading up to this recent surge in interest rate. And so back then, the LTVs of their loans were quite reasonable. So let's say at 60 to 70%. What this means is that if a property was valued at 100 million, they might have lended 60 million against it with the property as the collateral. So 60 million, that will represent a 60% LTV. So you have good margin of safety in case the borrower defaults on the loan. They can repossess the property, resell it, and likely recoup all of their principal, potentially even a gain on top of it. But the problem is that then this building that was worth 100 million suddenly saw its value drop down significantly when cap rates expanded, especially in some property sectors like office and hotels. And so as a result, I now expect Apollo as well as other commercial mortgage REITs to face increasing defaults and restructuring in the coming years. And given that Apollo has a pretty high dividend payout ratio, I think that it's likely not going to be sustainable. Just recently, we saw the first commercial mortgage REIT cut its dividend. It's called KKR Real Estate Finance, ticker symbol KREF. They cut their common dividend by 44%. I think they, by the way, also likely going to cut their dividend a second time sometime over the next year. I actually like their preferred equity, but the common equity is very risky. And yes, I think it's more or less the same story for Apollo Commercial Real Estate Finance. Good company, but their dividend likely won't be sustainable. So if you had to retain one thing from this video, it should be that not all REITs are worth buying. This is a sector in which you need to be very selective. It's very vast and versatile, and while some REITs are highly opportunistic, others are real landmines that are waiting to explode and could suffer significant losses. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. We have over 2,000 happy members. We have over 500 5-star reviews from members who are profiting from our real estate investment strategies through REITs. And you can join us for a 2-week free trial and gain immediate access to my portfolio, all my trade alerts in real time. I'll put a link to our landing page to learn more in the description of this video. And otherwise, once more, if you could please click the like button, subscribe to the channel if you like this type of content. I have many other videos coming out next week. Thank you so much, and see you on my next one. Bye-bye.